Here's what the smartest, most well-funded money on the planet is doing right now, and almost nobody is talking about it. Silver has just been officially reclassified by the US government as a critical mineral, and last week legislation passed mandating government-backed price floors for all critical minerals within 90 days. The stated reason? To incentivize domestic mining of resources that are increasingly hard to find and strategically vital. That's not a rumor, that's policy signed into law. But that's just the surface, because what's happening beneath it is something far bigger than most people realize. For decades, 8 Western banks, a couple in Canada, a few in Europe, 5 or so in the United States, have maintained what Andy Schectman, CEO of Miles Franklin and a 36-year veteran of the precious metals industry, calls the largest concentrated short position of any commodity ever traded on COMEX. Not one of the biggest of over 1,000 commodities ever. Why would they do that? Andy's answer is the military-industrial complex. The West has dominated the world through superior military technology, and silver is irreplaceable inside that technology. Cruise missiles, F-35s, stealth bombers, hypersonic weapons traveling Mach 5. The heat generated in the cone of a hypersonic missile is so extreme that silver is the only material that works. And here's the thing, if you're embedding 500 ounces of silver into a $20 million cruise missile, you don't care what silver costs. Price is irrelevant to that buyer. So the people who needed silver the most had every reason to keep its price suppressed on paper, and they had the tools to do it. Paper derivatives, short positions, Western bank collusion. For 50 years, the mechanism was simple: short aggressively in New York to drive the price down, take a corresponding long position in London that doesn't move the market, and swap paper back and forth. Warrants, promises, nothing physical. It kept the price capped. It worked until now. Here's what you need to understand, and this is the single most important data point in this entire conversation. Ask yourself who is standing for delivery on COMEX every single month. In December, it was the largest silver delivery in COMEX history for a December contract. 65 million ounces. In January isn't even a primary delivery month, and we're already past 40 million. In 40 days, roughly 120 million ounces demanded as physical metal, not paper promises, not contracts. Real bars, real delivery. A mint box of Silver Eagles weighs 42 pounds and holds 500 ounces. Someone is taking delivery of the equivalent of tens of millions of those boxes every single month for over 15 months straight since Trump won the election. Now ask yourself who has the capital and the connections to do that at that scale, repeatedly every month for over a year. These are not retail investors. These are sovereign wealth funds, central banks, institutions that do not operate on margin, and people who spend billions of dollars taking physical delivery of a commodity don't do it because they think maybe it'll go up. They do it because they know where this is going, and the mainstream financial media, silent. You have to ask yourself why. There's a second mechanism accelerating this, and it's the margin game turned against the speculators. On Christmas Day, it cost $21,000 to hold a 5,000-ounce silver contract on margin. Silver was trading around $60. The very next day, COMEX raised margin requirements by 30% overnight with no warning. Now you needed $27,000 or your account would be liquidated. Today, that same contract requires $45,000 in margin. Nearly double in a matter of weeks. This is not accidental. This is the same playbook used in 1980 against the Hunt brothers and in 2011 to collapse the silver price for 15 years. Raise margins until the leveraged speculators are forced to sell. Price drops, more selling, collapse. The difference this time, the buyers waiting on the other side aren't speculating, they're sovereign. When the margin squeezed traders are forced to dump, the big money, the money not operating on margin, absorbs every ounce. And the price keeps climbing. Silver was up $7 in a single Friday session, up $3 more when Asian markets opened. Each margin hike shakes out the weak hands. The strong hands accumulate. Meanwhile, there's a $12 per ounce arbitrage gap between silver prices in the West and what Shanghai is offering. If you're a trader, the math is simple. Buy paper contracts here, deliver physical in Shanghai, collect the difference. On 10 million ounces, that's $120 million in profit. That's the sucking, sound-draining Western silver east. China is literally paying premiums in dollars, losing purchasing power by the day to take your silver and leave you holding depreciating currency. And it goes deeper. China is expanding its Shanghai Metals Exchange throughout the entire Belt and Road Initiative. Southeast Asian nations, 800 million people, over 30% of GDP, are now trading through SIPs and Enbridge. Systems incompatible with SWIFT. Trade imbalances are being settled in gold, not dollars, gold. Think about what that means for the centric world we've lived in for 50 years. When global trade required dollars, countries recycled those dollars into US treasuries, keeping rates low and asset prices high. That system is unwinding. Nations are choosing gold, which has outperformed the 10-year treasury for 25 consecutive years. In 2024 alone, gold was up 40%, while the 10-year treasury returned 4.5%. The prior year, gold up 80%, treasury up 4%. Gold can't be weaponized, it can't be frozen, it carries no counterparty risk. And countries that have been on the receiving end of American monetary policy enforced at the barrel of a gun are voting with their reserves. Now, here's the math that should stop you cold. The precious metals market is tiny relative to total global capital. Rick Rule, one of the most respected names in resource investing, has long argued that just 0.5% reallocation from the entire financial matrix, from individual investors to the Harvard endowment into precious metals, would overwhelm available supply. Harvard, by the way, just bought several hundred million in gold. If that number moves to just 5%, Andy estimates a tenfold increase in demand overnight. But it's not retail investors setting this new floor. The chief investment officer of Morgan Stanley just publicly said the 60-40 rule, 60% stocks, 40% bonds, is broken. His new recommendation, 60-20-20, with 20% in metals. Michael Hartnett, chief analyst at Bank of America, told institutional clients 25%. Jeffrey Gunlick, the bond king who built his career selling bonds, said 25% isn't even overweight. If even 5% reallocation creates a tenfold demand spike, what happens when the institutions that actually move markets go to 20%? Andy's answer is direct. There won't be enough to go around. The market will be defined not by price alone, but by scarcity. People who wait will either find it too expensive or simply unavailable. There is far more paper money in the world than there are physical metals to absorb it. This is not the Hunt brothers in 1980 trying to corner a market. This isn't 2011 speculative leverage. What's happening now is structural. Sovereign nations are accumulating, governments are mandating strategic stockpiles. A proposal has already cleared one chamber of Congress to build a national strategic reserve of critical minerals. Silver is now in that category by law. The paper suppression mechanism that controlled prices for 50 years is cracking under the weight of physical demand that cannot be faked, papered over, or deferred. When the people with the deepest pockets and the best information on Earth start taking physical delivery at record levels, month after month, and don't stop, that's not noise, that's a signal. The only question left is, are you paying attention before the window closes or after? If this breakdown gave you something most financial media won't tell you, subscribe and hit the bell. This story is still developing, and you'll want to be here when it does.